All right, I got a real fun one for everyone today, and I just want to apologize ahead of time. I don't have my normal microphone, so this might not be the best quality. If it turns out to be not great quality, I'll just redo it at another point, but I'm really excited and want to give this content to you guys as soon as possible because my team and I have been working on a study that has to do with what happens when stocks and the VIX are up. We've been doing this study for a few months now, and we do have some results. And not only do we have results, but within those results, we do have ways for everyone who's watching this, all my market heroes, to make money from it, whether you have futures permissions or not. So this is a cool one. Again, we've been doing it for many months. I kind of had my hunch about this, my opinions about this, but the numbers aren't going to lie here, and they're definitely going to allow everyone to start making some money whenever they see this happen. So let's get right into it. So the title is Stocks Up, VIX Up, question mark. So we all know that what stocks are. Equities, stocks, Apple, Facebook, Netflix, all that stuff, okay? But when we speak about stocks during this presentation, we're going to talk specifically about the S&P 500. So for those that have been living under a rock, or if this is your first video on Market Hero, the S&P 500 is an equity index of about 500 primarily U.S.-based stocks of all different sectors. So there's some consumer staples, some industrial, some technology, some biotech, some healthcare. So what it is it's a basket of about 500 stocks that gives you a nice summary of what the overall stock market is doing. So when we think stock market, we're really talking about the S&P 500. Okay, so that's what stocks are. But what about this concept of the VIX? Now, the VIX has many different definitions or summaries depending on what television network you're watching or what blog you're looking at. But it's a measure of volatility, and volatility is nothing more than the perception of risk. Okay, that's it. It's just a perception of risk, nothing more. But we'll get into it a little bit more here in this video. Now, the VIX itself, VIX. So let's take a look at that real quick. VIX, the VIX itself. Let me just minimize this so we could all see it. VIX, the VIX itself, okay, is what we called a cash settled index. So what that means is there's no stock to buy or sell when it comes to the VIX. Okay, it's cash settled because every option that we trade, it settles to cash. And the reason they settle to cash is because obviously there's no stock. The VIX is not a stock. Okay, it's an equity index. It's a cash settled index. Okay, again, there's no volume here whatsoever. Okay, now on the other side, we have something called the VIX futures. Now, this video is not about futures specifically, but there are futures contracts that trade a futures volatility product. Their symbol is /VX. Okay, now we're recording this at 6 o'clock on a Monday. There are 130 contracts traded since in the last hour. That's not a lot, but as you can see, just looking by this, there is something to trade. Now, there's not stock to trade. There's a futures contract to trade, but there's something that you can actually buy and sell here. Remember, the VIX is cash settled. You cannot buy or sell the VIX. You can't do it outright. But /VX, the VIX futures, you can buy and sell that outright. As you can see, as we're talking here, people are buying and selling /VX, so VIX futures contracts, okay? So when it really comes down to it, and again, this is important, and I'll explain why here in a minute, but the pros, okay, they're actively trading the VIX futures all day. But no one's actually trading the VIX stock all day because, again, there is no stock. So when you think about it really, okay, the VIX futures, to me, they're a better indication of how traders are treating volatility on a given day because it's not a secondary measure. Okay, secondary measure meaning the VIX, that cash settled index, is a result of put buying on the S&P 500, not from the actual buying and selling of VIX, because again, you cannot do that. So let's look at it again. VIX, there's nothing to buy or sell here, and the price of VIX is based on the put buying and selling on the S&P 500. So the VIX is a secondary, I guess, indication of what's going on. It's a secondary measure of volatility because it's actually just gets its price from the buying and selling of S&P 500 puts. So you're not going to get a movement in the VIX until you get a movement in the puts in the S&P 500. But again, /VX, you can go ahead and buy and sell that whenever you want. So to me, again, the /VX, the volatility futures contract, is the real indication of volatility because you can directly buy and sell that. Okay? Now, since to me, VIX futures are really volatility, futures trade 24/5. Okay? So they trade more frequently. So as we're watching right now, again, it's 6 o'clock on a Monday, people are actively trading VIX futures right now, but no one is trading VIX, and specifically, no one is trading S&P puts right now because those are only available to be traded from 9:30 a.m. Eastern Time to 4 p.m. Eastern Time. And as we can see here and as we've been watching, futures trade very much 24/5. So again, just another reason why, in my opinion, the VIX futures are a real indication, a real indicator of volatility where VIX cash is not. Okay, so anyway, is there some sort of a tell? Because VIX futures are, to us, a real indication of volatility, is there ever some sort of tell that they have? Because, again, we think they're a leading indicator to VIX. So, here's what we ended up doing. And again, like we do in all of our cases, we do a study to see what the numbers say. So from 2000 to present, so depending on when you're watching this, it's at least over 18 years of data. So we looked at the ES, the S&P futures, and the /VX, the VIX futures, okay? And again, the S&P futures are very much just the S&P 500, but in a futures form. So we're looking at S&P 500 futures and VIX futures. And again, the thing to remember about VIX futures are they are the best indication of volatility because you can trade that product, where VIX cash, you cannot, okay? And what we did was we looked at times when the VIX futures were positive before 10:30 a.m. Eastern Time, and the S&P futures were also up at that time. And the reason we did that is because equities and volatility are typically negatively correlated. So most of the time, like 98% of the time, when stocks are up, the VIX is down because there's less perceived risk. And when stocks are down, the VIX is up because when stocks are down, there's more perceived portfolio risk. Okay? And that happens like 98% of the time. But what about that 2% of the time when stocks are up and volatility is up? So what happens, and we look to see what happens that day and 7 days in the future. Okay, so that's what we ended up doing. And here are the results. So we could see here from 2000 to present. So again, over 18 years of data, depending on when you're watching this video, but at a minimum 18 years of data. When the VIX futures and the S&P futures were positive, were both positive by 10:30 a.m. Eastern Time, the S&P futures then finished that day down 65% of the time. Okay? Looking out 7 days, they were down only 50% of the time. So when we're looking at this and we see VIX futures and S&P futures positive by 10:30 a.m. Eastern Time, we really only have an edge that day. And again, the edge that day is when we see the VIX futures and the S&P futures positive by 10:30 a.m. Eastern Time. The S&P futures over the last 18 plus years were finished the day down about 65% of the time. Okay? Now, S&P futures /ES. VIX futures /VX. Okay, so that's what they are. And again, we all have that watch list, Stevens Futures, that you can upload to your trading platform. But again, I look at them right here. They're very close to each other. So if I see from now on, if I see at 10:30 that S&P futures are up and VIX futures are up, I will definitely figure out a way to take advantage of what we have found here. But that's not all. Okay, we expanded on that a little bit more. Okay, because what we did before was we figured out if the S&P 500 was down for the day, but there's more to do. So we did the same study, 2000 to present, S&P futures and VIX futures. When S&P futures and VIX futures were both up by 10:30 a.m. Eastern time on the same day, rather than looking to see, wait, this is a little bit wrong, excuse me, I'm going to have to make an update right now to see S&P finish the day lower. Okay, no, that was right. Okay, so we look to see if the S&P futures were lower from that specific point. Okay, finish the day lower than it was. So if the S&P futures were up 2 and the VIX futures were up whatever they were, this study, instead of seeing if the S&P futures finished down for the day, this study looked to see if the S&P futures finished anywhere below 2. So if they finished up 1 for the day, this is where that study would come in, okay? And let's see how the results look like. So when we look to see when the VIX futures and the S&P futures were up by 10:30, the S&P futures were lower than the price than they were at 10:30, 81% of the time. So this one is even more of a big deal. Again, at 10:30, if the S&P futures and the VIX futures were higher over the last 18 years, that level at 10:30 that the S&P futures were, the S&P futures finished that day lower 4 out of 5 times, or 81% of the time. So this is the really big edge that we're looking at here. So let's kind of do a little bit of a takeaway. So looking at our numbers since 2000, on days when the S&P futures and VIX futures were positive by 10:30 a.m. Eastern Time, the S&P futures have an 81% chance of being lower than they are at that point for that day, and 65% chance of being down for the day. Okay? Now, it doesn't look like this trade has any benefits when looking out more than that given day. So a lot of you are probably saying, okay, what can we actually trade then? Because we don't want to trade futures. Well, look, the S&P futures, all it is a futures contract for the S&P 500. Okay? If you want to go ahead and trade straight S&P 500, you can't do it with stock. You can only do it with options, and you can do it with options on the SPX. If you didn't want to do SPX, whenever this loads, you could do you can't do that. You could do SPY. And what is SPY? Again, that is the S&P 500 equity index. So what you could go ahead and do is, if you see the S&P futures /EX and the VIX futures higher at 10:30 a.m. Eastern Time, you can go ahead and get short the S&P 500 Index ETF, SPY, at 10:30, knowing that 81% of the time, the closing price on that day will be lower than the price you sold at. And obviously, there are things that you could do within options as well if there are options that expire on that exact same day. And the good news is there are 3 expirations in every single week right now, sometimes 4. So that's definitely something you guys can do. So again, guys, really quick, when you see the S&P futures and the VIX futures up at 10:30 a.m. Eastern Time, there's an 81% chance that at the close of that day that the S&P futures are lower than the price they were at 10:30. So if that's your edge, you guys should definitely be taking advantage of it. I'll see you guys in the next video.